There is one undisputed heavyweight champion in real estate. Yes, that would be the Blackstone Group. The firm manages some $81 billion in property investments. Blackstone also completed two of the biggest real estate deals of all time. Equity office properties for about $39 billion and Hilton Worldwide for about $26. The man overseeing all of that is here today. Jonathan Gray. He is Blackstone's global head of real estate, and many say a front-runner to eventually succeed Steve Schwarzman as the firm's CEO. John sits on Blackstone's management and executive committees, as well as the board of directors, and he's a committed philanthropist who, together with his wife, Mindy, established the Bassler Center for Cancer Research at the University of Pennsylvania. John, welcome.
It's good to be here.
Nice to have you. Is it true that Blackstone's the only place you've ever worked?
It's all I've been at. I started out of college.
Phone number.
Yes, one phone number. I met my wife in college. I got my job coming out of college. This is all I've known.
Amazing.
He can't do anything else, I guess.
Well, what he's doing pretty well. You're here to talk about real estate, John. Yesterday, we had a gentleman sitting here named Tillman Fertitta. He is the founder, the chairman, the CEO of a company called Landry's, right, which owns the Golden Nugget casinos and a bunch of restaurant chains that you're familiar with. Morton's, for example.
Rainforest Cafe, a favorite of yours.
Anyway, he has a view on the U.S. commercial property market, which is a good place to start. He thinks it's overheated. He thinks it's heading for disaster. But I want you to hear Tillman Fertitta in his own words to start our conversation.
You're seeing just crazy numbers for real estate. You're seeing it in New York, probably more than anywhere else, but you're seeing it in Texas. You're seeing it in California. And, you know, history always repeats itself, as we always know. But I think it's going to repeat itself a little sooner this time. And so you can just see it coming. There's so many cranes.
You smell
everywhere.
a crash in the real estate market?
Absolutely, I do.
Absolutely, he smells a crash in the real estate market, and the numbers are crazy.
Yeah, I don't think we'd agree with that view. Look, we're clearly past the distress phase we were in coming out of the crisis, and valuations have moved up. There's more capital in the space. There's more debt and equity. Cap rates or unleveraged yields on real estate have come down. But the supply-demand fundamentals in real estate are pretty good today. If you look on the supply side, maybe Texas is an exception, but across the U.S., we're building about half of what we have historically. That's generally supportive of values. And the U.S. economy is accelerating. We've got GDP growth over 3%. We've got more than 200,000 jobs a month. That's not a formula that you generally look at for disaster. What tends to get real estate in trouble is lots of cranes. We don't have that today. Or when there's tons of debt capital. That isn't the case today. If you went back to 05, 07, lenders lending 90, 95%, that's not the environment we have today. What I would say is the rate of growth going forward will not be as good as what we've seen in the past. So we'll still have good fundamentals, good cash flow, but the cap rates are not going to move lower. So I think we move into a little bit more of a moderate growth phase, but I would disagree with those comments.
Why? Why a moderate growth phase? What would cause it to slow?
Well, what will cause values to slow, if you think about it in a stock market context, what drives stocks are PE multiples expanding or earnings expanding. Because cap rates today are pretty low, we don't think multiples expand from here, but we think earnings will grow. We think occupancies, cash flows. So as a result, you have sort of one of the two engines supporting you. That should lead to some growth, but not the same growth you've seen over the last few years.
Let's put up some of those cap rate charts because they help to make your point. There was a time when the spread was negative effectively between cap rates and let's call it the 10-year Treasury, a good way to illustrate, and cap rates have definitely come down. We could talk about any industry, right? It's the same case in hotel, it's the same case in multifamily, it's the same case in retail, it's in industrial. It all kind of looks the same. Here, for example, is what's going on in hospitality. Back in the sort of pre-bubble, let's call it, time frame, cap rates were trading through 10-year Treasuries. Now they're kind of close to the post-crisis low. Are they likely to stay there? Or when you talk about this moderate growth phase, are cap rates likely to tick upward?
I would say that cap rates could tick upward from where we are now as you see higher interest rates, you know, which everybody's been expecting but hasn't yet happened. But as I said, I think the earnings growth from the assets will more than offset that.
Okay, so here's the other factor in the equation, the incredible amount of capital that is available for real estate. I know you can't talk much about it because you're in the midst of fundraising, but Blackstone is raising a new fund. Your last fund was $13 billion. This fund, we understand, is likely to be as large. Put a few turns of leverage on that, and you're talking about 50, 60, maybe $70 billion to invest. The Norwegians are plowing tens of billions of dollars into the real estate market. The government of Singapore is pumping.
Question somewhere.
Yeah, somewhere.
It's coming, I
Just
swear.
to establish the context for the question.
Yeah.
Where does all that money go?
Well, real estate is a very large industry. It's more than $30 trillion globally on the commercial side. So 50 billion sounds really big, but in the context of this overall industry, it's not so large. I'd also point out again, if you went back to that bubble period, if you looked at the debt markets, the commercial mortgage-backed securities market was $230 billion. Today, it's $95 billion. So there's a lot less debt capital in the market. And then as it relates to us, I can't talk about fundraising, but what I can say is we're focused on the opportunistic part of the spectrum generally. We're focused on public companies that we may privatize, debt to get control of assets, assets that need to be repositioned. We just bought a big office tower here in New York where a couple of tenants were leaving. Those are not the kind of things that sovereign wealth funds are typically focused on. They want to buy long-term core assets that they can hold for appreciation, inflation protection. So I think when we look at our competitive dynamic today, it feels pretty good. There aren't very many people who do what we do in scale.
And you still think New York is a great opportunity? When I look at these mega towers being built in New York City right now, they all seem to be around Central Park. I wonder, does this feel toppy, no pun intended, given how tall they are?
Here's the view.
Yeah. So, it doesn't mean every asset class has the same supply-demand fundamentals. If you've got a lot of folks building $8,000 a foot apartments, you could take a sector and overbuild it. In the hotel business in New York City the last few years, even though demand's been really strong, there have been a lot of new hotel rooms added, and so revenues have grown much more slowly than the rest of the country. I think it's possible at the very high end on the residential side that the growth in value is not terrific, but at lower price points, because of the demand to live in New York, you could continue to see strength.
Can I ask, what do you deem to be a lower price point in New York?
You
like,
mean
I love
per
to see
square foot?
Yes.
Well, look, in Manhattan, prices, on average are north of $1,000 a foot. So by the standards of the rest of the United States, it's a very, very expensive place to live. The powerful thing supporting demand is so many people want to come to this city. They want to travel here. They want to work here. They want to live here. And as a result, there's a lot of demand, and it is hard to build new supply. So I think long-term places like New York and London are going to continue to do well. I think it's going to continue to spread out beyond Manhattan. You see it in Brooklyn today. It's going to spread to Queens. You see the same thing in London. People want to be in these global cities. Crimes come down. So I would stay positive, but it's often possible in a certain segment, like the super high-end, you could see softness with some overbuilding.
John, you mentioned that there are few companies or firms that can do real estate investing on a scale that Blackstone can, and I know that you've got a couple hundred people working for you. Nevertheless, if you're going to be putting tens of billions of dollars to work, you can't do it $500 million at a time. You need to be a big game hunter. Where's the big game to be found?
Well, interesting. I'd say a few places. Around the world, I think in Europe, if you look at Portugal and Spain and Italy, there's still a fair amount of dislocation there, a lot of distress. We've been quite active in Spanish housing, where, like the U.S. a few years ago, we created this huge platform, Invitation Homes, because we thought U.S. home prices had fallen. We think the same kind of opportunity exists in Spain. That could be a 40 billion euro space, so a very large asset class. In Asia, in China in particular, where there are a lot of headlines these days, that could be creating opportunity because the economy is slowing there, but there still are some good things happening on the ground. We think the government may look to privatize some of their SOE stakes, their government-owned enterprises. There could be big investments. And then back here in the U.S., I think when interest rates move up, you could easily see the stock prices of REITs trade off. It happened last year. People throw out their bonds, they throw out their utilities, and they say, gosh, should I hold on to my REITs? They may sell them. That could create privatization opportunities. So for us, we're always looking. What's attractive today may change. The nice thing is we have capital tied up for a long period of time, so we can be patient.
John, we're going to continue the conversation after this commercial break, so please stay right there. He's the global head of real estate at the Blackstone Group, Jonathan Gray, with us here on Market Makers. We're back. It's Market Makers here on Bloomberg Television. I'm Eric Schatzker.
And I'm Stephanie Ruhle. We are back with Jonathan Gray. He's Blackstone's global head of real estate. John, people think of you as the guy in the real estate space. Is there someone else you look to saying, I'd like to have that guy's skills, or he's the best competitor to me? Who is it?
You mean besides LeBron James or something
Obviously.
like that?
Besides LeBron James and Dwayne Wade.
Look, there are a lot of great investors around the world. I think everybody looks at Warren Buffett as the person who's shown himself to have sort of the best equanimity through cycles, good and bad. And as an investor, everybody wants to have a track record, to build a reputation, to look at businesses over long periods of time, to create value for their investors. I think like everybody in the business, we all strive to be like Warren in that way.
How about in real estate?
In real estate, there are obviously great investors who've done this a long time. Sam Zell has been tremendous.
That's who Eric guessed you would pick.
So,
there you go.
you know, Sam has been incredible. He's really, besides the fact he's done a great job investing over long periods of time, he really helped create the modern REIT industry with the companies he's taken public. He's done great. Steve Roth at Vornado, another real pioneer in the business, creating value. These are people I look up to in terms of...
What are the hallmarks, though, of real estate genius?
Well, I think the hallmark of real estate genius, or any investing genius, is looking at the world a little bit of a different way, having some conviction in doing something. So with Sam, you know, when things were down at the bottom in the early 90s, he went in a big way. Steve bought, you know, a failed department store chain. Actually, this building was the flagship Alexander site way back when, and he built a real estate empire on that. I think if people are able to see things differently and then act on that conviction, to me, that's really impressive.
Is there something right now you think that you are seeing a bit differently than the rest of the pack?
You know, there are different sectors. I'd say we've done things, for instance, in India. John Chambers was talking about this. We've gone out. It's a market everybody's hated. We set up our shop there in real estate in '06 and waited 5 years to make our first investment. And we had the opportunity to buy buildings at less than $100 a foot. The tenants were Cisco and Goldman Sachs and Microsoft and IBM. And we were literally the only folks buying in the market. We've now built up 30 million square feet in that market. And again, doing it in scale really makes a lot of sense. I think investors try to focus on diversification, which is good, but it doesn't generate outsized returns. To really do that, you have to find something you believe in, find a management team or partner to execute, and then really go all in.
John, one of the things that your public shareholders have had to learn to live with is the fact that Blackstone trades at a really low PE multiple. And it's the same story across alternative investing, whether it's Carlyle or KKR or the Apollo Management. It's all sort of clustered between 8 times earnings, trailing earnings, of course, and 13 times. It's a different story for the BlackRocks, the T. Rowe Prices, the Legg Masons of the world. I spoke to David Rubenstein, co-founder of the Carlyle Group, just the other day about this very issue, and here's how he responded. I want you to hear.
I suspect there will be some convergence. I suspect that the alternative firms will move further into asset management, and I suspect the asset management firms will probably move a little bit more into alternative, and there will be some convergence, as I say, but I don't think it'll be overnight that you'll see dramatic changes.
Is that the way to fix the problem, in your opinion, that the alternative asset manager buys the traditional asset manager to get some multiple premium?
I disagree, I think, with David on that in terms of, I think there'll be convergence, but in valuation multiples, not necessarily in the business model. I think for us, alternatives have been our historic focus. They'll continue to be that. And when we look at these companies, we say, gosh, you know, today we're growing at twice the rate of the traditional asset managers. Our forecasted dividend by the street next year is an 8% yield. The traditional managers are at 2%, and yet we're trading at half the multiple. And that seems odd to us. And
it seems odd to David, too.
So what's going to be the catalyst to change that?
I think it's time and us delivering. If you look in real estate, the factory outlet centers, you know, 10, 15 years ago traded at half the multiple of traditional shopping centers, even though they performed really well. We bought a big portfolio, and as they continued to perform, the multiples converged over time. I think as people understand these companies, see how powerful they are in terms of raising capital, the stickiness of the capital. Remember, most of our capital's tied up for 10 years. The margins of these companies, investors are going to say, hey, look, these are really special businesses and franchises. We should own these things for the long term. And I think you'll see that that multiple differential will go away. And as a shareholder, I'm happy to own my Blackstone stock.
But why has there been a disconnect until now? Shareholders simply understand a BlackRock or a T. Rowe more than they understand you?
Yeah, I think part of it was the timing. You know, we were born at a very difficult time. We IPO'd just before the financial crisis. Our financials, as a result, didn't look great. The results we produced, the way we're required to report makes the financials a little bit opaque. But I think as people see the steady dividend performance from these companies, they'll get more and more comfortable. So I just see it as a matter of time. What we've got to do is focus on executing our business, delivering for our limited partners, delivering great returns. And if we do that, it'll work out fine for our shareholders.
So, John, you started at Blackstone back in 1992 at a time when the firm was in private equity and M&A. And since then, it has expanded into credit. Obviously, it's expanded into real estate, your business, and into a number of other businesses, funds of funds, hedge funds, etc. You're about to spin off your advisory and restructuring business. Where might Blackstone go next?
Well, look, I'll start with the spinoff, which for us happened because it was like two families living in a house, and we'd sort of outgrown the house a little bit, in that our investment business had grown so large and our advisory businesses had also. And the idea of having a dedicated restructuring business in the same place where you invest in distressed debt doesn't really work. And so we wanted to get this business separated. We brought in Paul Taubman, who we think is a world-class investment banker and leader, to grow this business. And from a valuation standpoint, I think the market will say, wow, this is a really special business that was hidden inside this big investment firm. So I think this company, the spin-off company, has a very bright future. In terms of Blackstone going forward, what I'd point out is there's a big world out there. So we're very big in the U.S., we're very big in Europe, we're expanding in Asia. I think there's more opportunity. I think Latin America is a place where we could do more. And then there are other alternative asset classes, technology, infrastructure, other things over time, energy, that we could look at. We're in energy, but I mean some of the other natural resource areas. There are other places where we could go with our firm because we have the confidence of our investors and because we have a really rigorous investment process. And I think what's made this firm successful over a long period of time is we've grown in assets and people, but the basic process of investing has stayed the same the entire time.
We're seeing hedge funds under pressure to lower their fees. Where do you think PE fees are going?
Well, you know,
hopefully higher.
Yeah. I would say this, if you deliver for your investors, they're generally pretty calm about the compensation. They look at the net returns. And across our firm, in all our different asset classes, hedge fund solutions, credit, real estate, private equity, we've delivered. And as a result, we're not seeing huge pressure on the fee side today.
John, at some point, Steve Schwarzman is going to retire as CEO. I expect him to remain chairman forever. But that raises a question. How does Blackstone avoid what happened to GE when Jim McNerney and Bob Nardelli left after Jeff Immelt became the CEO, replacing Jack Welch? You know, there's you, right? There's Lawrence Tosi, there's Bennett Goodman, there's Joe Baratta. All this talent that is still very young and presumably very ambitious.
So I'd start by saying that Steve Schwarzman, who runs the firm and co-founded it, with Tony James, our president and COO, I think both love their jobs and have no plans in the near term to change what they're doing.
That's why I say eventually.
Eventually. Now, as you get to the eventual question, I think one of the nice things about Blackstone is because we have these other large businesses, we're not just a one-trick pony, that we do have a lot of talent who's got a lot of experience. And so there are a number of people who I think are capable of running this firm. How that plays out over time, I don't know. I think it will work out because there's enough opportunity within Blackstone, the scale of the firm. You know, I think there's a real sense of pride being part of Blackstone. The culture is very special. And you've seen a lot of people stay for a long period of time. I think even if down the road, years down the road, there's transition, there'll still be a lot of continuity at the firm.
Before we go, is there one real estate asset that you don't own today, anywhere on the globe, that you look at and you say, that's what we want to own?
That's interesting. Most of those things we can't hold on to forever. Look, I'd love to own the GM building here in New York. We had a couple opportunities. I wish in retrospect we had stepped up. It's a special piece of real estate.
You're going to have some money burning a hole in your pocket, though, when the Waldorf gets sold, won't you?
Well, Hilton is moving to more of an asset-light focus, and they're going to redeploy that capital in things assets that are less capital-intensive. That company's been performing really well. Chris Nassetta has done a great job. And that asset, the best thing about the sale of that asset is the buyer's going to reinvest a lot of capital.
But now you have nowhere to throw the Christmas party.
Very quickly, you started at Blackstone with a bachelor's degree and became global head of real estate. Bachelor's degree, could that ever happen again?
I think it definitely can happen again. I think when you look at a firm like ours, the idea of meritocracy, of people who care a lot, who have good judgment, who work hard, there's an opportunity to move quickly. And for a firm like ours to continue to be successful, we have to keep making those opportunities for young people.
What a pleasure. Thank you so much for joining us today, John.
Thanks, Stephanie.
This guy lives the American dream for sure. Thank you so much. Jonathan Gray of the Blackstone Group.